The Money Show.
Personal Finance with Warren Ingram.
Right, let's look at something that's been affecting all of us as South Africans, those high inflation rates that has been slowly eating away at the money we've been earning. One of the biggest enemies of salaries and wages is, of course, inflation. When inflation outpaces the wage increases that we experience in an economy, it can be quite tough to stretch that rand. We've experienced this at shopping tills, trying to make sure we get enough groceries. We've also experienced it in the repayments of some of the major ticket items that we've taken out in terms of housing loans and the repayment of cars. Inflation can make life quite difficult, eating away at our salaries. But Warren Ingram, co-founder of Galileo Capital and a personal finance feature host and guru, is going to tell us how we can survive the times, right? If it's not through the day-to-day running of your household, but how you can set up investments that can counter inflation and make sure that you have more money at the end of the day into the future. Warren, welcome to the Money Show. A key topic that you've chosen to cover today. Inflation is an enemy, hard to fight, but there are ways.
Very hard to fight. Just ask the Reserve Bank, who's trying desperately to get inflation down in South Africa, and the Fed's doing the same in the States, and no one's succeeding. So it's the problem with inflation is it's such a big headline thing when we talk about it as a country. We'll talk about the South African inflation rate and American inflation rate, and all good and well, but no one's talking about Motheo's cost of living increase, that happened over the last 6 months or year.
I think it's about time we talk about that, actually. Just my inflation increase.
Yeah, let's talk about you, Motheo. It's all about you tonight. So I think the big thing here is understanding that when you start worrying about inflation, the thing to know is that there are very few investments that will allow you to beat inflation over a long period of time. The two that do it best would be the stock market and let's say the broader property market. If you're a homeowner in Gauteng, you're going to tell me that there is no such thing as inflation beating growth out of houses in Gauteng. But if you own retail space or warehousing space around the country, then different story. So generally those are the two growth assets. The jargon we use is productive assets. The problem is they give you an almighty roller coaster. So, you buy your stock market investment and, let's say you do nothing fancy, you just buy an index. It's all good and well today. You put $100 in the index and three days later it's, $90. And then you start really cursing that guy on the radio that told you to buy the stuff on the index. But what you need to know is if you ride out the roller coaster over longer periods of time, it starts to deliver inflation beating growth. So you have to embrace the thing that we're not good at. You have to embrace uncertainty. We don't like uncertainty. Ask any South African before the elections. The one thing we didn't want was a kind of an uncertain outcome. We wanted to know what was going to happen.
Sure.
So that's the problem is we sit with something that's highly uncertain, but does give us inflation beating growth. So the issue we face is that most of us would much rather have kind of something that's stable and predictable and generates growth day after day after day. And the only thing that really does that's not a Ponzi scheme is something like a fixed deposit or, money market account or, something like that, an RSA retail savings bond. Very nice and predictable and stable. The difficulty is they don't beat inflation, especially when you've got to take tax off the income that you've earned from those.
Oh,
so
there's always the tax.
Yeah, you're going to have to trade your need for stability against the need for instability and then say, can I get a balance? Can I have a spread of some cash, some bonds, some property, lots of stock market investments, and then ride it out when it gets volatile? Then you've probably ticked the first big box, Motheo, on starting to beat this inflation monster, even the Motheo inflation.
And that's a very high one, I have to tell you there, Warren. Looking then at practical ways as a household to try and fight off inflation, things we can do in terms of another stream of income or maybe even reducing the amount we're paying back in terms of loans and things like that. Isn't that where we should be starting to try and get additional money into the home, then looking at setting up a portfolio that can beat inflation?
Yeah, we have to talk about that rude word that starts with a B called budget. The moment we say budget, I know about 50% of our listeners switch off the radio, but we have to talk about it. So we have to understand. We all know what comes into our bank accounts every month, unless you're Bill Gates or Jeff Bezos. But what we don't necessarily know is what's going out on a monthly basis. So that's the first thing, is go and figure out what's leaving your bank account every single month. And if you use a lot of cash, then go and understand what you're doing with that cash. And then start to prioritize what's important to you. So if it's really important, to you, Motheo, that you've got to get that coffee in the morning, and you're willing to trade that coffee against, I don't know, a nice meal in the evening, then by all means do that. But you've got to get to the point of saying, well, I can't have the coffee, every morning and then a weekly meal. I've got to do one or the other. Find a gap. Find a thing that's important to you, that's rewarding, and yes, spend your money on that. But then the things that you're just kind of mindlessly buying because you kind of, you subscribe to something on your phone, or you just buy stuff because everyone else is doing, and it gives you no value and no meaning. Those are the things you need to cut out and cut down, and create that gap to start being able to save a bit on a monthly basis to beat this inflation problem.
Then looking at our finances, especially when we look at things like retirement and savings, how important is it to free ourselves of the debt that we carry in as we go on in our careers, especially when we're closer to hanging up, our careers and going off into the sunset if we've saved enough? How important is it to just shave off the debt before using that money we've saved up to pay all of these loans?
I've got a hashtag for you. It's debt is a weapon of wealth destruction. I know banks love giving us debt, and I know they make it really easy for us to use our credit cards, and they almost incentivize us to spend. But just understand that for most of us in our lifetime, debt is the thing that destroys wealth. It doesn't create it. There are people that have very successfully used debt to start businesses or grow their businesses very quickly. But most of us use debt to consume stuff that has no value. We use debt to buy clothes that have no value the next day, or to kind of go on holidays, and those are great. They leave you memories, but you can't eat those memories afterwards. So getting rid of debt is a key thing. And maybe just to break that debt down, it's a bit like that movie, The Good, the Bad, and the Ugly. There are three kinds of debt as far as I'm concerned. So good debt would be the debt that you incur on things that will grow in value. For most of us, that will be a home loan. That'll be, we eventually buy a house one day. Over long periods of time, the house will appreciate, even if you've got a house in Gauteng, but it's going to take a long period of time. And so that's probably good debt, as long as it's affordable to you on a monthly basis. Neutral debt would be, for most of us, would be buying a car because we need transport to earn a living. So if you're buying a fairly simple, fairly low cost, definitely second-hand car, you're doing well, and you've probably got neutral debt. If you're buying the latest sports car or that German sedan, and it's costing more than, your accommodation, then the likelihood is that's falling into bad debt, unfortunately. But for most of us, the only kind of neutral debt I can think of is transport costs, around South Africa. And then the really bad debt is the stuff we spend on personal loans, overdrafts, and credit cards. And those are the things we have to get rid of as fast as possible, Motheo, because they're growing at probably twice the rate of inflation, and probably twice the rate of what our stock market investments would give us in this country.
If you're wondering what we're going on about, it's time for our personal finance feature, talking about unlocking financial freedom, how to protect your money from the slow poison of inflation. Currently in conversation with Warren Ingram, the co-founder of Galileo Capital. And after this, we'll be talking about how to diversify your investment portfolio good enough so it can beat inflation.
Money Show. Personal Finance with Warren Ingram.
Warren Ingram talking to us tonight about unlocking financial freedom, how to protect your money from the slow poison of inflation. If you worry about inflation when it comes to your earnings, salaries, your wages, you should worry about inflation when it comes to the earnings you get from your investment portfolio and your savings. Warren, looking at how you can set up an investment portfolio that has a nice mix that could beat inflation in the end. How would you set that up, and what kind of companies would you be looking at?
So I think understanding that, if you really don't like volatility and you don't like the craziness of stock markets, you at least have to have about 40%, Motheo, in the stock market to beat inflation. So the balance of your money you can split between government bonds, property, and cash. But at the very least, all of us would need a minimum of 40% in shares. And when you're talking about companies, I mean, I'm pretty agnostic. I think we shouldn't try to be too clever when it comes to the stock market. We should be humble enough to say we don't really know what's going to happen over the next 5 or 10 years, and that's the time frame for stock market investing. So if you're going to buy, into the stock market, follow the diversification rule. In other words, don't go put all your money into one company. You've got to go and buy a whole lot of different companies.
But trying to find those companies that can keep profit margins high even when costs are rising, like we're seeing in the current environment, can be quite tough. How do you do that research? Are you looking at fast-moving consumer goods? Are you looking at retailers, big ones that, we all have no choice but to buy from despite the higher prices? What kind of industries are you looking at to make sure that you can outpace inflation when it comes to your investment portfolio?
I'm not clever enough to understand which ones are going to be the kickers in a portfolio, Motheo. So I'm always going to defer to, let's say, a top 50 index or a general equity unit trust if I'm going to buy a stock market. What I will do is buy 50% SA and 50% global, just to make sure I've got a very good spread. And especially the global part will give me huge exposure to the tech companies that are changing the world, from the US, or the pharmaceuticals in Europe, or the Asian companies that are taking advantage of their amazing demographic profile and the growth story of their economies. So I would be very careful to kind of allocate money very specifically to 1 or 2 or 5 businesses in SA, unless you're a real expert. So if you are a retailer and you understand the retail sector very well, and you happen to think, I don't know, ShopRite is changing the world, then by all means allocate some money to ShopRite, but don't go and allocate all of your money to the one company. You really need to spread your risks, because the truth is we are going to be surprised. We might see something blow up, or we might see something do incredibly well, but spreading your risks will help you with that growth.
Somebody will tell you that they invested in a property, one they live in, and it's been quite tough to repay it. But looking at real estate and the real estate investment trusts as well as a form of trying to beat inflation, would that be a good idea?
I think they offer one very nice advantage, real estate investment trusts, and that's that they are very diversified. You're not buying one property in one city in one country. You're buying lots of properties, but potentially across the country. And if you choose your real estate investment trust correctly, you might be buying one that's got exposure to kind of distribution or warehousing. It might have some office space. It might have some retail, might even have student housing, for example, which is a huge need in South Africa. So you're looking for something that's really spread and diversified. And then one thing I do like about these real estate investment trusts is it doesn't cost you nearly as much to transact in a REIT, is what they're called, as it does to transact in a house. You're not paying estate agents, 5% transaction costs and lawyers' fees and all that stuff. You're paying some transaction costs. So I like the REITs, but they're kind of a small market in South Africa. So I think they at most make up 10% of your portfolio. The balance should be in shares. So if it's you and me, Motheo, and we're growing our portfolio for 20 years, I've said the minimum you should have is 40%, but I really think most of us should be around about 65 to 75% in shares. The balance you spread between REITs and bonds and cash.
Somebody will say things like commodities, gold as safe as houses. They are more old-fashioned and willing to hold on to commodities over the long run. Are they inflation beating?
Gold is kind of like it's almost an article of faith. But I think some people love gold and they think it's the best thing ever. It's so safe, and then you'll get people like me that will say, well, the only time you can make money from gold is if I buy it and I hold it and I wait for everyone else to be more afraid of the state of the world than me, and they're willing to pay more for the gold than I did, and then they buy it from me. But if that takes 10 years and I'm sitting on it, it's paying no interest, no dividends, no growth other than price, and I don't like it.
Then looking at how flexible we can be, especially with our retirement savings as we go along, trying to make sure that the sum that we get when we retire is enough to beat inflation. Is this a question that we're asking brokers? Are we picking up the phone and keeping on checking on the money that we are saving so we can adjust the premiums as we go along?
Yeah, I think this flexibility is two parts. So one is, pre-retirement and the other is post-retirement. So a lot of retired people, they start out their retirement and let's just say they're going to draw, for arguments of, 20,000 a month. And they want to go on one holiday a year and they want to buy a new car every 5 years. But unfortunately, let's say it's time to buy the new car, it's year 5, and the stock market is down and everything's looking really uncertain and unstable. What they should do in a situation like that is postpone the car purchase by a year. Wait for markets to recover. Wait for the portfolios to recover, so that they get more value out of that money than selling it when it's lost 20 or 25%. So in that sense, being flexible about when you draw your money once you've retired is important. On the other side, if you're at pre-retirement and the stock market is down 25 or 30%, then maybe don't go and splurge on some kind of luxury item that you were kind of planning to kind of go on a nice holiday or something. Maybe take that money in that 1 year and buy the stock market because it's down 25%. That means there's a mighty sale on that. You're going to get a great return if you're patient on that investment. So it's about being adaptable to the markets. Yeah. I think it would be nice if someone phoned you about it, but I think you're going to have to keep your eyes open for yourself.
Then let's look at our listener question for this week from Cedric, saying, I've had to revisit my budget recently because times are tough, and that's true. I've since spoken to my short-term insurer and realized that I can reduce my premium by increasing my excess from 2,000 Rand to 5,000 Rand. So if something happens, I'll be able to take 5,000 Rand for my emergency fund. Is it a good idea to increase the excess to reduce the premium? And should I shop around for other quotes?
So last part of the question first. Absolutely, Cedric. You have to shop around for short-term insurance. So I always think, get at least 3 quotes. If you've got the patience, get 5, and then show the quotes of all 5 to each of the 5 companies that you're dealing with to say, I've had a quote from this company. This is company A. You as company B, you're charging me $100 more a month. Why? What are you giving me more than the company A is doing? And once you've done a bit of homework around the quotes and you spent a bit of time on those things, you'll figure out who's actually giving you a good deal and who's giving you a bum deal. So I think definitely you have to shop around. And I love the idea of increasing your excess. The more you increase your excess, the more it's telling the insurance company that you're not going to make silly claims, where you claiming for $1,000 because actually you're going to pay the $1,000 if your excess is 5,000 Rand. So you're not going to make small claims. You're only going to make big claims when something big has happened. And that's what insurers like. They don't want you claiming all the time.
Yeah.
So increasing your excess as much as you can is a great idea. I think it will reduce your premiums a lot.
Well, Warren, as the gems are flowing and you're giving us more pointers, time tends to run out. Thank you so much for joining us today for our personal finance feature, Unlocking Financial Freedom, how to protect your money from that dreaded inflation.